As traders, we can be our own worst enemies, from flaws in our thinking to letting our emotions get the best of us. But there are tools to help us conquer the mind games we play on ourselves. Now, in this episode, we'll show you how technical analysis can solve 3 common behavioral biases. You're watching Inside Investing. Hello, everyone, and welcome to the show. I'm your host, Jason Nadek. Joining us is David Keller, founder of Market Misbehavior, a YouTube channel dedicated to helping traders hone their skills. Dave, great to have you here with us today. We appreciate you taking the time.
No, I appreciate you, Jason. Thanks so much for the invitation.
Yeah, happy to have you. Looking forward to a great discussion. I know the audience is going to enjoy this. Just a quick question to start us off here. Your work involves around an interesting blend of both finance and psychology. Can you tell us a bit about where that came from and a bit about your Market Misbehavior channel?
So it's interesting. As an undergraduate, I had the very common background or the common career trajectory of studying music and psychology at The Ohio State University. And what's interesting is I was looking for a steady source of income and found a firm in New York that was willing to train liberal arts majors to analyze the markets and to help their clients. And what's interesting is psychology just mapped so well to investing decisions and particularly technical analysis. So the moment I found that there was a set of tools to really help you better understand what investors were thinking and what was motivating their buying and selling, and how charts could actually help you quantify those decisions, I was completely hooked. So I find investors and active traders especially spend way too much time trying to be perfect, trying to have an incredibly good P&L, trying to win on every trade, and not enough time thinking about what's happening between their ears. And so for Market Misbehavior, our channel is really devoted to understanding that interplay between the evidence that you can gather about the markets and the evidence that you can gather just by having a good conversation with yourself. And hopefully we help people make better decisions at the end of the day.
It's a very interesting backstory, and I'm really curious to dig into that and see how we can connect the dots for the audience as we get going here. All right, now, before we get into our conversation, just a quick note to those viewers. Go ahead and subscribe to our YouTube channel, TD Direct Investing, so you don't miss an episode of Inside Investing. And make sure to let us know in the comments what you think of today's episode and what else you'd like us to cover on the show. Now, with that said, let's get started. Now, I know one of the tools that you like to put some emphasis on, and I'm a big proponent of this, is keeping a trading journal. Now, is there things that you like to cover in this journal, and why do you think that's so important for investors?
If you don't have a good process where you're reviewing some of your decisions that you've made and really thinking critically about what decisions you made and why, what's motivated those, and how the evidence might have changed afterwards. If you're missing that, then you're missing a great opportunity to improve. I keep it super simple. I have a paper journal that I have in front of me, and when I make a decision, I write 3 lines on that journal. Line 1 is, here's the trade that I made. I bought X shares of Y stock at this level. Line 2 is why, and I keep it super straightforward. Like, this was the main thesis behind that decision. It was based on earnings or a breakout, hit a particular level, a particular signal, whatever it is. And then that 3rd line is so important, which is what would tell me I'm wrong. That's your exit strategy. And so often I find traders wait until the trade's not working, and then you start thinking about what you're going to do about it. And so for me, having that journal and then having a regular time that you schedule in your calendar, for me, the end of the year is a logical time. The end of each quarter is a time I do that as well. Look back at the last period, the last quarter, and really dig into what were your best decisions. Why were they so successful? What did you use? What information did you consume? How did you manage risk versus return in those areas? But then especially more important, look at the losses. Look at where things did not go as you would expect. Did you manage risk effectively? Did you limit your losses? Did you hold on to your winners? And did you minimize the downside risk in some of those losing trades?
We're talking about having exit strategies, not just in a profitable perspective. Like, we got into the trade because we think we're going to make money, but we're also kind of doing a little risk management at the time. So we we can help, stop those losses before they get too out of control, and we're taking a hands-on approach to our own trades. So yeah, well put.
Yeah, one of my favorite quotes about that: all large losses begin as small losses. That's my favorite risk management quote. So if you can make sure you define your downside risk and limit it to that, it's just a lot of times I think having success over time is just living to trade another day. And so make sure you focus your attention on that with every trade.
Yeah, it's just as simple as that. Maybe that's a little quote you put on a sticky note and stick to your computer monitor, and you can help remind yourself of that little maxim there. That's a good point. All right, so now some traders take a bottom-up approach that focuses on individual securities, while others are taking more of a top-down consideration for larger market trends. Which do you prefer?
I mean, honestly, I do some of both, but I really favor more of a top-down approach as a general rule of thumb. And especially you've seen that in the last couple of years. There have been some key macro themes that have really driven risk assets in the last couple of years, really since the COVID low. So I think having a good sense, a good awareness of the overall environment. And even if you're trading in a short term, if you're day trading, making short term trades in a particular security, you have to remember that you are interacting with investors on much different timeframes. Right? You're interacting with a money manager in New York that is, making large changes in their allocation. You're trading in some ways with a hedge fund that is doing some sort of option strategy. So understanding those big picture themes and what sort of decisions are causing large changes of capital to rotate positions, I think is vital.
Now, with that said, even thoughtful traders have behavioral biases that can negatively affect their trades. So let's dig into some of those common ones and how technical analysis can help traders curb them. All right, the first one we're going to look at here is confirmation bias. How can traders fall into this line of thinking?
This is by far the most common one that I've seen, Jason, and working with a lot of traders. It's so prevalent. We almost think that it's normal. You should gather the evidence, right? Think about what the evidence is telling you. What is the environment telling you? And then make your decision based on the weight of the evidence. We often just completely flip that around. So we make our decision first. I'm bullish on Bitcoin. I'm bearish on this particular stock. And again, not talking specific, but just generalities about a particular asset. When you sort of make the decision first, then when you're gathering evidence, all you're trying to do is validate or confirm the decision you've already made. So instead of gathering evidence with no bias and seeing what the way that the evidence tells you and then making your trade or then taking your position, you kind of mentally take your position first, and then you try to gather evidence to make yourself feel better about a decision you've already made. The risk with confirmation bias, of course, is that you're taking a position not because the market suggests it's a good thing to do. It's because your sort of silly brain is telling you it's a really good idea. And then when the market goes against you, you're confused and disoriented because you don't have a good way to validate it. So I always encourage people to use what I call an evidence-based approach, which means forget about your position, forget about your overall investment thesis, forget about what you think about the markets. Have a regular routine where you're just gathering evidence and then decide what you should do based on the weight of that evidence. Compare the evidence to your current positioning, and then you know if you need to make a change.
Asking you a question about social media might be a bit of a loaded question that we don't want to tackle here. But from a financial perspective, how can you tell maybe if you're in an echo chamber? Where do we go to find kind of contrarian opinions to maybe what we think we already believe?
Yeah, no, it's really tough, and I would say for social media in particular, I mean, the algorithms on any social media platform are really designed to keep you looking at the platform, and the way that they have learned to do so is by feeding you information that validates something you already think. Right? What I like to do is actively look for contrary opinions. So if you are bullish on a particular stock, literally search for bearish and the ticker. If you're bearish on a particular asset class, search actively for bullish that asset class and just see what comes up and try to put that other hat on. Think about what the contrary point of view really represents. Look at what evidence they're considering that convinces them of the opposite conclusion of yours.
And from a technical analysis perspective, you say that there's two indicators that can help us fight that confirmation bias, one being trend lines, the other being moving averages. How can they help?
What I love about these indicators is technical analysis really is designed to be more of an objective view of what's happening. It is designed to tell you what the trend is as you define the trend based on a trend line, for example. And then it gives you a clear sign when that trend is no longer active. And so recognizing when the evidence is changing, what I would call a change of character on the charts, is vital. And that's what tells you when a position you might be holding is no longer the right position. It might tell you when a perspective you have is no longer accurate because the evidence is changing as defined by the markets. When a market is going higher and you draw a trend line off of the lows, there's a very clear sign when that trend is broken. That just tells you the market was in a particular phase. Now it's different.
Right. Now, you'd like to pair those two indicators with a technical study called the Relative Strength Index, or it's more commonly known as RSI. Why is that?
RSI is a measure of price momentum, and it's a great way to validate what you're seeing about the trend overall. It's sort of, if you know statistics, kind of like taking a Z-score for the market, for the price action. Sort of, takes the noise out of the way and just looks at the overall price swings. And generally speaking, markets tend to overshoot and undershoot a particular level that they should be on any time frame, on a short-term minute-to-minute time frame, on a long-term month-to-month, year-to-year time frame. You see a lot of those same patterns. One of the clear danger signs that I look for is what's called a bearish divergence. And this is when prices are going higher and the RSI, a measure of momentum, is starting to slope lower. You're actually seeing that right now in a lot of stocks, a lot of ETFs that have had really strong runs. You see this divergence, right, where price goes one way, the momentum starts to rotate lower. So this is when the RSI, to be a little technical, when the RSI is overbought, when we're making a new high, and then we make another new price high, the RSI is no longer overbought. And so that divergence, higher prices, lower RSI, this is something that really helps address confirmation bias, because once the market goes higher, you kind of start to get pretty bulled up on whatever that price is. And you sort of assume that those price trends are going to continue forever. A divergence like that, right, when the price goes higher on weaker momentum, often can be a sign that that bullish phase that we've experienced is probably near its end point. So any sort of winning trades, any positions that are continuing to gain, I'm always looking for a divergence that might tell me sort of that early warning that we might be in a position where that uptrend is exhausted. You might want to think about downside risk and maybe locking in some of the gains that you've experienced so far.
That sounds like it's more of a leading indicator, which is nice to hear, as opposed to maybe a lagging indicator like a moving average might be. Am I interpreting that right?
Really well said. And I think with the couple that we've talked about so far, trend lines, kind of a lagging indicator, right? Because it defines the trend. We break through the trend line, then that tells you the trend is over. Moving averages are a way of, sort of identifying potential support, but we break those moving averages after we rotate lower, and that's sort of a confirmation. As you implied, Jason, divergence is more of a leading indicator, which is what I find is really helpful to use these together, because that'll be your early warning system. This might be a top. Trend lines, moving averages can be more validating, more confirmational, saying, okay, yeah, that definitely was a top, and now I really need to change my position. So using those sorts of leading and lagging indicators together, powerful combination of technical analysis tools.
All right, so let's take what we've just learned with the three studies and indicators we've just talked to, and can we walk through an example we can apply those and show how that can help with confirmation bias?
Yeah, so we're looking at one particular chart here where we've got a series of indicators we could use here. And I would say coming off of the lows in October, we sort of made a new high in January. And you can see what is a consistent pattern of higher highs and higher lows. So as the price has made higher highs and higher lows, we're above two upward sloping moving averages, which tells us the trend is positive. We can draw a trend line from the key swing lows going back for the last couple months and clearly define that trend is going higher. What's interesting is we've already had that bearish momentum divergence, right? So the new high in December, then the new price high in January is actually seeing weaker momentum. So we have actually seen that early warning sign that uptrend may be exhausted. Now what you're looking for is that validation, looking for a trend line to be broken. The moving average pretty far below current levels. You have to see if that moving average can hold on a pullback. But overall, I would say this is a great example of where you combine all of them together. The early warning has fired, and now we're looking for the confirmation from trend lines and moving averages. And this is the kind of chart, this is the kind of ticker I would put on a watch list. This is what I would have on my trading platform, just to say, okay, here are some stocks that are potentially rotating. These are the levels that I'm going to look for, an alert, just to make sure that I don't miss a particular breakdown, and really causes you to review the charts regularly.
All right, Dave, the next behavioral bias on your list is the endowment effect. What is that, and how might it negatively affect a trader?
This is a sneaky one, Jason. It might be tough for some people to embrace this or accept this one because what it is basically you have an emotional attachment to a position. And when the evidence turns against you, despite the change of the evidence from clearly supporting your trade to going against your trade, you still hold it. And I bet anyone listening can come up with an example of where you held something just a little too long, right? A position that was working for you, you feel like a rock star stock picker or because the thing keeps going up, but then it starts to rotate lower, but you hold on to it. Not because the evidence tells you to keep holding on to it, but because that's your position. You can't sell it, right? And so there's this emotional attachment that causes you to experience losses in your portfolio way longer than you probably should. We mentioned earlier that quote of, all large losses begin as small losses. And what you want to do, I think the way that you survive to trade another day is by admitting when a position you're holding is no longer working. But one thing I've learned in my career, and Jason, you probably learned the same, you're wrong a lot. And so recognizing and admitting when you're wrong, minimizing the pain in those losses, I think that's just a huge part of trading success over time.
Where my mind went was with that endowment effect is you don't want to be known as the hoarder of stocks, right? We've got emotional attachments to these things, but sometimes it's time to let go and move on and look for another opportunity. So what technical studies or indicators can we use to help us avoid this?
Yeah, so this is one where I think that support and resistance levels are really key. This is a basic part of the technical analysis toolkit, which is literally looking at where the price is at any given moment and looking to the left on the chart. And again, this can be on any time frame. So you can look at a 1 day, 1 minute chart. You can look at a 10-year weekly chart, and you'll find support and resistance levels are prevalent. And that's because traders and investors on any time frame really think about, they have a memory. I was often taught the market has a memory. There are particular levels that tend to resonate. And there's actually been academic research for years that proves out that markets will gravitate to particular, pivot points or particular levels that have meaning. I always encourage people when I'm teaching technical analysis, when you're looking at a chart for the first time, we don't want to read it like a book from left to right, which is what a lot of beginners do. You want to read it right to left. So, you want to think about the current moment where we're at right now, and then look to the left and think about where we're at relative to where we've been. And those, the simple way to think of it if you're just getting started is look for those points that stick out, right? Those peaks that stick out, right? A high surrounded by lower highs, those lows that those valleys that stick out, a low surrounded by higher lows. Those are some key turning points. And those often will have memory because someone was buying and selling around those levels. They probably vividly remember that. And when we retest those levels, they're going to become important again.
And you touched on this, briefly in your last answer. When we're interpreting support and resistance level, it can depend on the time frame of the trade. Can you expand upon what you mean by that?
The reality is if you look at equity and ETF trading, particularly equities in North America over decades of data, you'll find that the time frame you're on can imply different behavior. So in the short term, what I think of is like a couple days to a couple weeks. And again, you could go shorter or longer than that, of course, but my sort of general thinking of a short-term time frame, markets tend to mean revert. So support and resistance levels can be very helpful at identifying short-term turning points. So if we're coming down and we approach a support level, you'd expect that to be kind of a floor where we might bounce higher. A resistance level would be a level we're trading up to. And so in the short term, particularly during the trading day, looking at the last couple of weeks, identifying some of those key turning points can be really helpful if you're looking for limit orders. You're looking for particular price levels at which you want to take action, places to manage risk. That's where you might want to look. Really think about the mean reversion. Think about those as places where you may want to be placing orders, particularly price gaps, which you find a lot on equity charts can be helpful as support and resistance levels as well. As a medium-term or long-term investor, those same levels can be helpful, but it can be more for trend following, right? So when a level of resistance is reached and then broken, as you've seen from a lot of like AI stocks recently, right? You had a resistance level, all of a sudden it's eclipsed. That tells you that something is different, right? Something is new and that more buyers are now being motivated to accumulate at higher and higher levels. As a longer term time frame, think about when those levels no longer hold and recognize that might tell you there's a shift. What do we call a change of character? Something new's happening on the charts.
Now, you mentioned support and resistance being broken. Is there something practical a trader can do, or to other indicators we can look at to help confirm if those breaks in support and resistance are going to hold?
So a lot of times you'll find a support level ends up being right at a 50-day or a 200-day moving average. So then you have two different disciplines all agreeing at one particular level. And so when you have a confluence of support, I think that further validates the importance of that level, because a lot of traders looking at a lot of different charts are all going to kind of key in on that level. It might end up being sort of self-fulfilling prophecy, I guess, for lack of a better term.
All right, great point. Appreciate that. All right, so now let's take a look at another example for the audience and apply those technical studies and indicators and see how we can counter the endowment effect.
This particular example has a very clear price gap, right around $97, $98. You can see in December, we broke above, or we gapped above that level, made a new swing high, but then it kind of stalled out there around 102, 103. From there, for the next couple of weeks, we were sort of range bound between that gap level around 97, 98, and then the upper end of the range around 103, 104. At what level, what pattern would you need to see to tell you that this is no longer a good position, right? As something that's really helping your portfolio? I would argue when it breaks down through that gap level, which would also mean a breakdown below that support from early January, that would be enough to tell me that something's changing, right? The conditions are just different. And if I'm holding paper gains right here, making sure you have that support level keyed, and this is where I would set an alert on whatever trading platform I'm using and saying when this level is hit, this is where I want to take action. So wherever you have a position, I would always say, look to the left, look at key support levels, recent swing lows, make sure that you draw a trend line at that level, make sure you set an alert at that level. And when we break it, whether or not it tells you to take action, it certainly should tell you to review the position. I think, recognizing when something that you own is no longer adding value to your portfolio, you really need to reconsider whether you still want to own the position. One final point I'll make about this, Jason, we always use what we call the new money question. If I had new money to put to work, would I put it in this stock right now? And if the answer is no, then why would you have old money, right? Why would you have your existing capital in that position? So the new money question is a great way to sort of gut check some of those stocks that you or ETFs that you might own, a great way to address endowment bias and recognize when the evidence no longer supports your thesis.
All right, that new money question sounds like a good fourth question to ask yourself when you're doing your quarterly and annual check-ins on your trade journal. So yeah, good point there. Let's move on to our third behavioral bias that we're going to cover here today, which is overconfidence. And with that, we'll also speak to overtrading. How might overconfidence work against a trader?
There's a problem when we start to think that we are better than the market, I guess is a way to think about it, right? It's that belief that that our skills are better than they are. And this often happens when we have a run of good performance, right? When we have a string of really good trades, our P&L is improving, the market is doing exactly what we expect. We start to attribute all of that success to our own skill, right? I am having such a good run because I'm such an amazing trader. I get it. My process is awesome. I can do no wrong. And I'm just going to keep doing this forever. And we probably all know, if you've experienced one of those runs, you know what happens pretty soon after is things change, right? You start having a run of bad luck. And what happens is a lot of times when we start to struggle, we want to trade our way out of it, which is never a great solution, right? So what you have to remember is a good trader isn't always trading. You're not sitting there hitting buy and sell nonstop. You're being thoughtful. You're developing a game plan so that when you actually go into the market, you have a good structured way of thinking about it and hopefully a systematic way of assessing potential rewards and potential risks as well.
So which technical studies or indicators can we use to help us kind of avoid that fine line between confidence and overconfidence?
So for me, overconfidence is best addressed by having a systematic approach, right? What overconfidence really is our emotional evaluation of our success is sort of overtaking our systematic or objective way of evaluating the markets. And you want to get back to that. So I actually have a technical analysis checklist that I literally use. I have for years. And when I teach new analysts, new traders how to use technical analysis, we literally write this from scratch and I force them to write out the answers one by one. So if you're just new to this, if you're just new to trading and you're new to technical analysis, I would encourage you to literally put pencil to paper and answer some questions and lay it out very clearly. Here's what the evidence is telling me. Here's what the weight of the evidence is, and make sure that you're following the checklist and don't get away from it. If you make decisions without the checklist, you can very quickly put yourself in a downward spiral of sorts with your trading.
All right, Dave, can you walk us through your investing checklist and maybe talk us through the order at which the events are in?
Absolutely, and it's interesting, Jason. I would say the order is actually pretty important. As we mentioned earlier, I think you want to start big picture to small picture, micro to or macro to micro, and I think you'll find with the checklist that's kind of how we're laying out these 7 steps to evaluate any chart using the technical analysis toolkit. It starts with trends. So number 1 is called Dow theory, and this is Charles Dow's work of analyzing price trends. An uptrend is a pattern of higher highs and higher lows. A downtrend is a pattern of lower lows and lower highs. This first step is to assess the overall trend characteristics of any chart. My 7-year-old son, Henry, I always think, what would Henry say when you show him a chart? Is it going up or down? He's actually pretty good at following the Dow theory and correctly addressing whether it's going up or down. So you want to start with that simple assessment. And if you skip that first step, all the other questions are less meaningful because you have to first define the trend that the price is in. The second item would be moving averages. And this is, of course, a way of smoothing out the price action over time. A moving average is simply a way of minimizing the noise of the day-to-day movements, what we call the flickering ticks of the market, and look at longer-term trend changes over time. And again, on any time frame, moving averages can be helpful to sort of minimize the noise. So I tend to look at the 50 and 200-day moving averages, just look at the shape of the moving averages, how they're trending, and overall, where is the price relative to those key smoothed out measures. The third item would be support and resistance levels. As we mentioned earlier, this is a really valuable way of identifying key levels that the market has found important. So look at where we're at, look to the left on the chart. Where are we at relative to where we've been? And what key levels stand out to you where the market has experienced a reversal before? The fourth item would be price patterns, things like flag patterns, pennant patterns, head and shoulders tops, cup and handle patterns. A lot of these, I would say, are visual ways of defining the trend in the market, but also really helpful to identify when the market has hit an equilibrium. So a lot of times a consolidation pattern, a basing pattern where buyers and sellers are kind of in agreement and then something changes and we break out or we break down. And so recognizing those patterns can be helpful to really understand the overall psychology of investors at a particular point. The fifth item is called RSI, the Relative Strength Index. As we mentioned, that's a measure of price momentum. So it's really more of a way of looking at how the market has traded over time. And if we have sort of overshot or undershot a particular price level, whether the market is at an extreme swing to the upside or the downside, and we might expect a little bit of a mean reversion, also really helpful for identifying divergences. The sixth item would be what I call confirmation. And the main indicator I use for that is called MACD, the Moving Average Convergence Divergence Indicator. This is a trend following indicator, just a way to get away from the pure price action and just define the trend with more of an objective measure. Just make sure we confirm any reversals to the upside or downside in the price. And then the final and arguably the most important of all is your exit strategy. And I mentioned in my trading journal that third line is key, which is what would tell you on the chart that your position is wrong. And so defining your risk, for me, using technical analysis tools that we've mentioned previously, so important. And again, I wouldn't make a decision without checking each of those 7 boxes, then looking at the weight of the evidence based on those technical inputs. Then you make your buy and sell decision after that.
Now, looking at the checklist, what's nice about that, when we combine that with the tools that traders can use in a practical environment, we've got study sets that you can save right into your platform. We have screeners that you can use to identify those particular patterns, and then there's that trading journal that Dave and I are advocates of that can really help you understand and really stick to that checklist to ensure that you're putting your best foot forward. In terms of an example with regards to the overconfidence bias, can you walk us through that and how those the studies and indicators might help to prevent that bias?
With this one that we're looking at, going through the checklist that you shared, Jason, it starts with the trend. And I do the Dow theory, right? Which means are the highs getting higher? Are the lows getting higher? And we can see in this case, they certainly are, right? We have a pattern of higher highs and higher lows. And all that means is traders and investors, all the different participants are pushing the price to a new swing high when we rally. When we pull back, we're not getting down to retesting those previous lows. And so the fact that we're having higher highs and higher lows implies that additional buying is coming in, buying power, as we would like to describe it. And so investors and traders are buying on the dips. They're buying those tactical lows and pushing it higher. So thumbs up so far, the Dow theory price trend is positive. The moving averages in this case are both sloping upwards. So one of the things I would look for is what's the slope of the moving average? The 50-day moving average, the 200-day moving averages are sloping higher, which implies get away from the noise of the day-to-day price action. The overall trend is constructive. We've recently broke above a resistance level to the third point. So there's a resistance around 140, which we had set back in September and October. We broke above that level, briefly retested that from above, and now making a new swing high. So resistance has been eclipsed, and we're seeing a breakout of a basing pattern or sideways pattern. I don't know if I would see any particular price patterns. That's the fourth item, looking at head and shoulders patterns, flag patterns, pennant patterns. You might have seen a bit of a pennant pattern kind of November, December, but overall I would say this is, just more a classic uptrend at this point. The RSI is actually improving. So compare this to some of the previous examples where you had that divergence. You're actually not seeing a divergence in this case. You're actually seeing the momentum improve. And then finally, the MACD is a moving average convergence divergence, in this case, constructive following the trend higher. The exit strategy is key. And for me, I would always key in on the most recent swing low as an initial assessment of a stop, an initial stop loss. So around 140 was where we had what's called a hammer candle, just a pullback and a highs and lows, or open and close near the highs of the day, a long lower shadow that often is a good support level. And so you find that right around 140. So this is the sort of chart that looks constructive and you have a clear exit strategy. But the key with what I just said is a disciplined process. Every chart I look at, I literally go through those 7 steps. If you've not answered those 7 questions, you don't deserve to have a position in that particular stock.
Yeah, that checklist really helps to make sure you're not kind of letting the biases take hold and you're not trading in a vacuum, and you've got those confirmation of the signals across all of those different indicators that you've been speaking to. So yeah, great. All right, and just a quick reminder to our audience, if you'd like to learn more about another trader's approach to active trading, well, you can check out our past webinar. It's Ask Me Anything, answering your questions about technical analysis with the guest speaker, Patrick Serezna. It's available on the Learning Center, on Webbroker, and on TD's YouTube page. All right, David, we're going to have to leave it there. Thanks for filling us in on how technical analysis can help traders conquer their behavioral biases. Hopefully this helps our viewers sharpen their minds and their trading skills. Now, before we go, do you have any final thoughts you'd like to share?
It's really interesting. What I've always been attracted to in the trading world is the fact that you're always learning. I remember attending an event early on in the 2000 or so in New York. And I remember attending an event where an older gentleman in his 70s was raising his hand and asking questions of a speaker. And I remember looking around the room and thinking, if I'm in my 70s and I'm still learning and growing, what a great discipline to do through the course of your life. So I wish all the viewers, all the listeners, much trading success, and always be learning. There's always something new to learn about the markets.
And no doubt that our audience will be learning from this experience. I know that I did as well. So Dave, thanks again for joining us here today. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content. It's available in the Learning Center and on our YouTube page. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.